Hello, I'm Sima from APC Finance Consultants. Let's talk about today's key economic events. The U.S. Core Consumer Price Index CPI will be released. Since the broader CPI includes highly volatile prices, this core index excludes food and energy costs, as these are essential goods and consumers continue to purchase regardless of price fluctuations. Additionally, global political and economic conditions often cause significant price swings in these categories. By removing these volatile components, the core CPI provides a more stable readings of inflation, especially during periods of economic expansion or contraction. Higher than expected readings may be seen as supportive for the US dollar, while lower readings could indicate weaker inflationary pressure. The US Consumer Price Index CPI monthly and yearly reports will be released. The monthly CPI measures the rate of inflation in goods and services prices compared to the previous month, while the yearly CPI assesses prices inflation relative to the same month of the previous year. The monthly CPI holds significant importance as it is the Federal Reserve's preferred indicator for making interest rate decisions. Based on its reading, the Fed evaluates its monetary policy to determine whether adjustments are needed to combat inflation. A higher than expected reading signals the inflation remains above desired levels, reinforcing the case for continued monetary tightening, which could support the US dollar. Conversely, a lower reading may ease inflation concerns and weaken the currency. The Bank of Canada BOC interest rate decision will be announced. The BOC's Monetary Policy Committee meets 8 times a year to determine the short-term interest rate. Following the meeting, the bank releases a statement outlining its decision along with a brief commentary on the economic conditions that influenced it. More importantly, the statement often includes signals regarding future policy direction. Interest rate decisions are primarily based on inflation, as the central bank's main objectives is to maintain price stability. When inflation exceeds approximately 2%, the BOC may raise interest rates to curb rising prices. A higher interest rate generally strengthens the Canadian dollar, while a lower rate may put downward pressure on the currency. Thank you all for watching. See you next time.